Most traders think a bearish engulfing candle means the market is about to drop. That belief alone is why most people lose money selling the market. In this video, I'm going to show you what a bearish engulfing actually represents. When it matters, when it will completely trap you, so you can stop guessing and start selling the market with structure. This exact framework I teach inside my book, Mastering the Bearish Forest, where selling is about precision, not aggression. Let's be clear about who this video is for. If you're looking for a quick flip, random entry, or selling just because you see a red candle, this video is not for you. If you sell every bearish engulfing without structure, you are not trading. You're just reacting. But if you are a disciplined trader who wants clear rules, proper stop loss placement, and confirmations before selling, you are exactly where you need to be. This channel is for traders who want to trade less, stress less, and execute with confidence and not gamble. A bearish engulfing is not a red candle over a green candle. It's a shift in control. Buyers try to push price higher and fail. Sellers step in with enough strength to completely absorb that buying pressure. The candle itself is not the signal. The change in control is the signal. This is why two bearish engulfings can look the same and have completely different outcome. Most traders see a bearish engulfing and immediately sell it. They do not ask where it was formed. They don't ask what the market was doing before it appeared. They do not ask if the market was even ready to sell. A bearish engulfing in the middle of nowhere means nothing. A bearish engulfing at a key level means everything. This is why people say the strategy doesn't work, when the real problem is how they are using it. Bearish engulfing works because it's created at an area where it traps buyers. Buyers enter thinking price will continue higher. When sellers step in, those buyers realize they were wrong. They exit, creating additional selling pressure. Smart sellers do not chase the market. They wait for the market to show weakness, then they execute. All right, okay. Let's look at a clean bearish engulfing that actually makes sense. Okay, so let's look at this real quick. All right, first thing first, notice where price is located. All right, so notice where price is located first, right? So we're looking at this right here, right? This is where price is currently is, okay? Not the candle. So we're focusing on where the price is, where the market currently is, not the candle, okay? You can see that market buy up, right? With this last daily candle, you notice that it closed above the exact turnaround point and indicating that it's going to continue up, right? Because it closed above it. This is what I mean when I said earlier that it trapped buyers. It created a trap for buyers because that bullish candle closed above the zone. They thinking that the market is going to continue to go up, but that's not the case. Okay. as you can see, eventually you did get a bearish candle. It wasn't an engulfing, but it engulfed more than 50% of the last selling candle. Okay. So at this point, buyers are losing momentum. Okay. The next bearish candle, which is this one right here, okay, is the one that engulfed the last bullish candle, which is this one right here. Okay. The moment it went past this point, it closed down here. That's the engulfing point. So here you have a 3-candle bearish engulfing. Okay. This is the type of bearish engulfing that you're looking for. When this bearish engulfing form, it's not random. Okay. It is in response to it is in response to failed buying pressure at a key level. Okay. So basically this is a key level. Last time market got here, it fell. Okay. When market went back to the same area, we looked to the left to see what the market did last time, so we could join the market when it gives us what we're looking for to sell the market. Okay. So again, it is a response to failed buying pressure at that key level. Right. This is the type of bearish engulfing you pay attention to, not because it's red, but because it's where it formed, okay? Because it formed at this point, all right? This right here would be your entry for that bearish entry. Targeting the next target low, but of course, by entering here, you put your stop loss at the last high to go down. This is a perfect example of that, okay? All right, look, now look at this bearish engulfing right here, right? This bearish engulfing right here. What's my color? Right here. So we have another 3-candle bearish engulfing, but in the case of this one, it engulfed the last 2 bullish candles. I'm talking about this as a bearish engulfing, right? On the surface of it, it looks perfect. But look at the location, all right? It's not at a key level. This right here is a key level, okay? It's not at a key level, okay? No clear structure, no reason for price to fall. This is where most traders sell too early. Price continue higher, like you can see right here, right? Stumbles. Price continue higher, right? Price continue higher, and they get wiped out. So naturally, you would enter here, stop loss at the high, continue higher. It would have stopped you out, right? This is not the market failing you. This is selling without context, okay? So I'm clear this out. Boom. All right. So again, key level. Okay. Bearish engulfing, middle of nowhere, not at the key level. If you enter, stop loss at high, as you can see, market wick you out. No structure. Again, this is not the market failing you. This is selling without context. Okay. So you need your key levels. Okay. And then, of course, your bearish engulfing to fall. Very simple. Okay. Let's clear this up real quick. Look, as you can see, the higher time frame show a clear direction, price returning to a key area of resistance. Okay. This is what I mean by that. Look. All right. The early entry that was taken was within here. It was not at this key level. Okay. You could see that market was going up, especially right here, to get to this key level point. Let me clear this out, enlarge it to make it a bit easier for you to see. All right, look. Like that right here. Okay, so the trade the earlier entry that we talked about, right, was within here. We could see that market was going towards this key level right here. So the higher time frame, okay, the higher time frame show a clear direction, price returning to a key area of resistance. Okay, we're gonna drop down to the 4 hour where we normally enter our trade for or sell or buy, because we do our setups on a higher time frame, monthly, weekly, and daily. Higher probability, easier trade. Okay, so we're gonna drop down to the. Let me minimize this real quick. Okay, hold up. We're gonna drop down to the. We're gonna drop down to the 4 hour, real quick, and we are going to go right back to the setup. Okay. Okay, right here. Look at this real quick. All right, make it big and visible so you can see it, right? So again, of course, that zone got hit twice, okay? So right here was the early entry. The higher time frame show us how the market was going back up, like I was mentioning before. And the bearish engulfing confirming sellers step in with intent right here. So we have, again, a 3 candle bearish engulfing where it took 2 candles, 1, 2, to engulf the last bullish candle, like so. Okay. Here is your entry. All right, let me clear this out. And then stop loss, of course, go at the high peak, like so, right? Yes, went up, consolidate, but it did sell. So this right here, right? This is not a rush. This is not emotional. This is not selling with, this is selling, to be exact. This is selling with permission from the market, right? This is how you remove the guesswork from selling. All right, so this is not a rush. This is not emotional. This is selling with permission from the market. This is how you remove the guesswork from selling. All right. So the bearish engulfing confirming sellers are stepping in with intent. All right. We'll clear this out one more time. Okay. The early entry was within here. We needed to wait for the market to hit this key level, like so. Okay. Took 2 bearish candles to engulf the last bullish. At this point, you enter for the sell. Think about the name, bearish engulfing. You're simply waiting for sellers to take over, to join the market. Plain and simple. Okay. I want to make this very, very clear. Also, please understand, I don't sell just because I see a bearish engulfing. I sell because the market gives me confirmation. All right. The bearish engulfing must close. What I mean by that is, a lot of time, I'm going to use this right here as a perfect example, right? Even though we had it twice, let me collapse this. So we're going to enlarge this real quick. Okay, hold up. All right, let's focus on this area here. Okay. Drop it low, stretch up. I want it to pop out so you can see it as clear as day. Okay. All right, look. Market hit zone right here. If you pay attention, right, this bearish candle right here did went below the point where you would want it to close, right? But it did not close. It went all the way back up to close like so. This is what I mean when I say the bearish engulfing must close. No anticipation, no guessing, no hoping the market will fall. Wait for wait for confirmation. All right, just wait for the confirmation is basically look, waiting for the confirmation is what separate traders from the gamblers. All right, I find it to be very funny because it's something that I used to do, but because I used to anticipate the market because it was at a low point, I didn't think that it was gonna go right back up. Okay, so keep it very, very simple. Again, let's say we do not sell just because we see a bearish engulfing. Okay, we sell because the market gives us a confirmation, of course, at a key point. The bearish engulfing must close. Okay, like close. Okay, it has to close as at a point where it engulf. Okay, this one is where it engulf, but it has to close. You see how this one went all the way down just the same way, but just to close above it and then to go right back up and then to close as an engulfing. Again, it has to close. Okay, because if we don't wait for the candle to close, we're gonna get cooked. Okay, so no guessing, no anticipation, no hoping the market will fall. Waiting for confirmation is what separate us traders from gamblers. Okay. All right. So with that being said, right? With that being said, when we enter this trade right here for the sell with our bearish engulfing price action, okay, my stop loss is always going to be placed above the high that caused the rejection, not at a random number, not based on emotion, based on structure to be exact. Okay, so the previous high, when you take a sell, you put your stop loss at the last high. So let me just draw it out for you, that way you can see it too. So let's just say we have this, right? Something like this. Let's just say the market would have come back to this point here and hit like so. You enter here for your sell. You're looking at the previous high to put the stop loss. If not, you're looking at here. So here is where we enter our trade, okay? And that's the high of rejection. That's the high that we have to put the stop loss. Let's just say hypothetically, if the previous structure point, let's clear this real quick. So let's just say the previous structure point, let's just say it was like this high, right? And it fell, and this is this high, this one went, and it give you the price action here. When I enter my trade, I'll put my stop loss at the last high. That's what I mean by that. Okay. So my stop loss is always placed above the high that caused the rejection. That's one. Not a random number, not based on emotion, based on structure. If your stop loss feels uncomfortable, it is not the strategy. Okay. It's not the strategy. It's the entry. Proper stop loss placement creates confidence. Okay. Proper stop loss placement create confidence. What I mean by that is, if you enter in the middle of the market and you put in the stop loss at an area where you feel uncomfortable, as if you're risking too much, or you feel like it might go back against you, it's because it's at the wrong level. But having the key level for your setup plus your price action, there is no emotion involved. You take it for what it is, and you put the stop loss where it belongs. Very simple. I had to slow down a little bit, speaking a little bit too fast, but yeah. So also, just what we want to make sure we understand this: the higher time frame tells me the direction where the market is going. The lower time frame tells me the timing. I do not fight strong trends. I align myself with the market direction. This is how I avoid forcing any trade. So again, the higher time frame tells me the direction because it dictates where the market is going for the month, for the week, and for the day. The lower time frame tells me timing, as far as the 4 hour, when I say the lower time frame. Okay, within the 4 hour time frame, when market hit my key level based on the higher time frame at around 1,509. When that 4-hour candle closed, it will basically tell me when it's time to enter the trade. Okay. Lower time frame, give me the timing to enter. Higher time frame, give me the general direction. I do not fight strong trends. I align myself with market direction. This is how I avoid forcing any trade. Okay. Whenever you're in the market, if price is moving strong with no weaknesses, do not sell. If there is no clear level, do not sell. If you feel rush or emotional, do not sell. No trade is always better than bad trade. Really though, think about it, right? No trade is always better than a bad trade. All right. So no trade. If you don't take any trade, it's always going to be better than you taking a bad trade. I just want to make sure I'm making myself clear. Okay. So again, if price is moving strong with no weaknesses, do not sell the market. If there is no clear level, do not sell the market. If you feel rush or emotional, do not sell the market. No trades. So you not taking any trades is always better than a bad trade. Okay. Most traders do not lose money because their strategy is bad. They lose money because they rush, they fear of missing out, so they sell too early. Patient is not a personality trait. It is a skill that you train. Okay. I want to make that very, very clear. Okay. Most traders do not lose money because their strategy is bad. They lose money because they rush, they fear of missing out on a move. Because of that, they enter way too early, put the stop losses too tight, over leverage. So you need to have patience. Okay. So always remember, patience is not a personality trait. It's something that you train. So it's a skill that you train. Okay. You train yourself to be patient by following these steps. All right. By giving yourself the best possible chance to be successful. Also, with that being said, one good sale does not make you a consistent seller. I'm going to repeat that one more time. All right. One good sale does not make you a consistent seller. Consistency comes from discipline, not confidence. Overconfidence causes traders to ignore rules. The rules that you write down, the rules that you tell yourself that you was going to follow. And the market always punishes that. The rules that you break. When you break that rule itself, the market will punish that. Okay. So I'm going to run it back by one more time. Okay. One good sale or one good trade does not make you a consistent trader. Consistency comes from discipline, not confidence. Overconfidence causes traders to ignore their own rules that they wrote down. You don't want to be that guy, or you don't want to be that trader. Okay. And the market always punish that. I am speaking from experience. Okay. So we don't want to sabotage our sales when we enter the market for a sale. So remember, most traders sabotage themselves by 1, over trading. Okay. 2, revenge trading. 3, over leveraging. But primarily just number 1, to be exact, I should have said that first, just not following your rules. Right? They stop waiting for confirmations. They stop respecting locations, and they start chasing the market. Okay? So just remember that. To avoid sabotaging your sales when you enter the market for a sale, okay, you want to wait for confirmation, respect the locations, the zones that you mark, okay, and wait for the market to tell you what it's going to do. So most traders sabotage themselves by over trading. They stop waiting for confirmation. They stop respecting locations, and they start chasing the market. Okay. So they stop doing the things that they're supposed to be doing. Instead, they start doing the things that they're not supposed to do. Okay. Okay. So, let's clear this up real quick. All right. If you want these entry selling framework broken down step by step, it's fully laid out in my book, Mastering the Bearish Forest, Advanced Selling for the Forex Market. Okay. I'll leave the link below if you want to go in deeper to learn to understand the setups that you need to look out for in all 5 different variations of double tops and all 5 different variations of bearish engulfing that the market might give you to sell. Okay. And also, I would really appreciate it if you were to subscribe. That way you don't miss out on the next video. We're going to go over why most bearish engulfing fail and how to spot the one that actually leads to a real market drop. All right. So make sure you subscribe. That way you don't miss out on that.